have a CPA, then you really should be working with a CPA to help you through the loan forgiveness process. And I'm so glad that we have Gary Franklin on with us today, because he's going to go into some detail about the forgiveness process. So let's go back to the beginning. So in March 27th of this year, and if Linda, you have the slides, you can pull up the first slide if you have it. All right. So if you remember back in March 27th, 2020, that was actually when PPP actually came on board. And the way that it was enacted was that 75% of the money was to be used for payroll, and the other 25% was to be used for expenses. Your lease rent expense, your interest on a commercial mortgage,
we lost you.
Actually, utilization costs, gas.
I'm sorry, I think you're breaking up. We can't hear you. Okay.
I'm back. I think I'm back.
So.
Can you hear me?
Now we can.
Am I back?
So far.
Can you guys hear me?
Yes.
Yes, we can hear you.
Okay. All right. So those were the uses for the funds. Okay.
I'm sorry to interrupt. Are we looking at a slide? Because I'm only seeing the cover slide.
Yes, that's all right. Still stay on the cover slide.
Okay.
For now. And so then on June 5th, President Trump signed into law the Paycheck Protection Program Flexibility Act. And one of the things that it did was it extended the time that you had to actually be able to hire employees back and to use the money before asking for forgiveness. Also, it changed the percentages of how the money was to be used to 60% for payroll and 40% now for the operating expenses that I mentioned. After that, then the SBA came out with some guidance for forgiveness on the two forms, the easy form and the long form, which Gary will go over in a few minutes. Now, what I want to do is talk about something that people are still not taking advantage of, and that's the debt relief under the CARES Act that was actually passed. So Linda, if you could go to the next slide. All right, so you have, and go to the next slide, please. So thank you. So under the Debt Relief Act, which was passed under the CARES Act, for existing and non-existing SBA loans, you can actually ask for a deferment for up to 6 months. So for a 7A, 504, or microloan, you approach your lender and ask for a deferment for up to 6 months on those existing SBA loans. If you have an existing disaster assistance loan, which comes out of the Office of Disaster Assistance through the SBA, that loan can be deferred through December 31st. If you have a non-SBA loan, say for example, you have a commercial mortgage or a line of credit or a term loan, again, you would reach out to your banker and ask for that deferment of those loan payments for up to 6 months. All right, next slide, please. Now, what makes this all possible is that actually the OCC and the FDIC actually sent out a joint letter to all the financial institutions across the country, actually strongly recommending that they actually, once you, as the business owner, ask for deferment, that the banks actually live up to that and give the deferments to you all right? Now, what's important about that is, one, you as the business owner's credit score will not be negatively impacted, because anytime that a loan is placed on deferment at a bank, typically it negatively impacts the personal FICO score. And for the bankers, typically only after 90 days, when a loan is actually on non-accrual, typically that loan is put into the bad asset section of the bank. But due to COVID-19, that's not going to be the case. And so the lenders are actually able to keep their good standing with the OCC and FDIC. Next slide, please. So as we know, the banks, credit unions, and fintechs were used to process the PPP loans. As you know, the SBA actually processed the EIDL loans. The EIDL money, actually, as I found out yesterday, has $180 billion left, okay? $180 billion is left for money in the EIDL program. So if you've already received your PPP money and you have not actually applied for EIDL, go ahead and apply for EIDL. Hurry up and apply for EIDL, because we've had 6 million applications for EIDL from across the country, okay? And so I think those funds will be running out pretty fast. And so go ahead and apply for the EIDL money if you have not done so. New PPP loans, as all of you should know by now, are not being processed through participating banks. The last date to apply was actually August 8th. As of August 18th, and actually as of yesterday, there was actually $120 billion in PPP money that was not used. Now, frankly, who knows if Congress will come to an agreement on passing another round of PPP, or frankly, putting more funding into the EIDL program. The Democrats are saying, you know, $2 trillion to another $3 trillion is needed. President Trump says he only wants to sign off on $1.3 trillion, okay? And so obviously they're at an impasse. But one thing that really we should be paying attention to is that most of the talks are centered around the unemployment benefits. You don't hear much talk about PPP and EIDL funding. It's around unemployment and whether it still should be $600 per week, or if that number should be $300 or an extra $100 per week. And then giving more money to the states for schools and hospitals. But you really don't hear a lot of talk around PPP or EIDL. So at this point, I don't know if there's going to be additional funding. Now, this is a Rod Johnson editorial. Since there's about $125 billion left for PPP, I just don't understand why they just can't extend the date from August 8th, right, until the money actually runs out, so that we can put more money in the hands of new business owners to sustain their businesses. But again, that's a Rod Johnson editorial. All right, next slide, please. All right, so we all know about the program. It was up to $10 million for a loan amount, reflecting 2.5 times the firm's average monthly payroll cost. The interest rate is 1%, which in my lifetime, a 1% interest rate on any commercial loan is just unheard of. No loan fees. We've talked about the funds were to be used for payroll costs and benefits and other allowed expenses, including the mortgage, rent, and utilities. Here's another one. No collateral, no personal guarantees. Never in my lifetime, particularly my 32 years of lending, have I ever done a loan with no personal guarantees or no collateral for closely held businesses. All right, the maturity, 2 years on loans made prior to June 5th and after this date increased to 5 years. The first payment, no payment required for at least 1 year, the covered period plus 10 months is what it actually comes out to. And of course, there's no prepayment penalty. All right, next slide, please. Now we should be talking about the 60-40 rule, which I already mentioned before. It went up, well, it actually went down, I should say, from 75-25 to 60-40, and how the money is to be used. Please use the PPP money in the manner in which it has already been outlined since March 27th. There are people being prosecuted for the misuse of PPP funds. People going out buying Maseratis, buying the 35-foot boat, okay? Buying the new home, buying investment property in the Bahamas. And these are real live examples because these are what are coming across my desk at the SBA. People are being turned into the investigator general at the SBA because people are misappropriating the use of these funds. So please use these funds in the parameters of what the program was designed to do, which was really to keep your employees employed and off of unemployment for as long as you can, and to use it for select expenses. You're not to use it to redo your website. You're not to use it to pay down existing lines of credit or term loans. You're not to use it to hire a new business development person, okay? These are the type of questions that I've been being asked. Stick within the parameters of what the money is supposed to be used for. I do not want to be reading about you in the Wall Street Journal, okay, or the Washington Post. All right, next slide, please. All right, the EIDL. Well, when the EIDL program, and if you guys recall, back in March, this was actually the first program that was designed to actually assist businesses, okay? If you remember, President Trump was on TV and he said, I'm going to ask Congress for $50 billion to help, businesses sustain themselves. But that was actually the EIDL program. This was the EIDL program, all right? And at that time, it was, you could get up to $2 million. But because the SBA was flooded with so many applications and the money was running out, then we had to lower the amount, the maximum amount, up to $150,000. The interest rate, 3.75 for profit businesses, 2.75 for nonprofits. And actually the use of funds are the same as PPP with the exception of accounts payable, okay? So you can actually use EIDL money to pay your payables. Now, unlike the PPP, EIDL doesn't have the restriction of saying 60% for payroll or 40% and 40% for other expenses. So as long as you use the EIDL funds for what it says here, then you're fine. Unlike PPP, there's no forgiveness under the EIDL. It is actually a 30-year loan, okay? There's no loan fees. There's a personal guarantee required. There's no prepayment, no payment for the first 12 months. Yes, interest does accrue, because I get that question. Interest does accrue, just under like PPP, which a lot of people don't realize, interest does accrue, okay? And there's no prepayment penalty. There is collateral for loans that are $25,000 or above. They'll take a first lien or UCC1 on the business assets of the company. If it's under $25,000, then there won't be any collateral required. Next slide, please. And we're coming toward the end, because I really want us to get to Gary so we can talk about forgiveness. Now, if you remember under EIDL, there was an advance or quote grant, okay, for up to $10,000. So it was $1,000 per employee up to $10,000. Well, there was $20 billion set aside under EIDL to cover that. And about 6 weeks ago, all the $20 billion of the advance or grant was actually used. So that is no longer available under EIDL. So now all you have is just the EIDL loan program, not the EIDL advance / loan program. All right, next slide, please. So if you need to know the status of your EIDL loan, you see the information here, disaster customer service at sba.gov. And you see the 800 number of 659-2955. Unfortunately, I can't assist you with the EIDL because my contact has left to go to another position within the SBA. So at one time, if you had your reference number, I could call and tell you where you were in the queue to get funding, but I can no longer do that. So use one of these two mechanisms to find out where you are in getting funded through the EIDL program. Next slide, please. All right, and this will be the last one. So doing a PPP and EIDL processing, I've heard people tell me that they've paid as much as $8,500 to get assistance to get their PPP or EIDL loan processed, either with the SBA or through the participating banks. Please, please do not be paying any fees like that. You have SCORE, you have the Small Business Development Centers, you have the Women Business Centers, you have the Veteran Business Outreach Centers that will actually help you if you need assistance for free. These are our tax dollars at work, okay? So please do not be paying any exorbitant fees to get assistance to apply now for the EIDL program. There's just no need to do that when you have these available resources to you to assist you. They will also assist you with the loan forgiveness, okay? Because they've received training on how to assist people to fill out the long form as well as the EZ form for loan forgiveness. Now, Gary Franklin is going to go more in depth about the loan forgiveness for PPP. Gary, as you go through your presentation, I hope you will concur that maybe you don't want to be asking for forgiveness right now. Maybe you want to wait a month or so. Let's see what Congress does before actually, wanting to go to the bank and apply for forgiveness. So let me tell you a little bit about Gary. Gary Franklin is a CPA and is a partner with the DC Metro Tax Practice for Con Resnick and has more than 30 years of tax and accounting experience. He is a member of their private client services group, and Gary provides tax planning and strategy to owners of closely held businesses and high net worth individuals. In banking, we call that the private banking group. And so Gary is a graduate of the University of Maryland. He has a bachelor's degree in what we would expect, accounting. And so without further ado, Gary, please take it away.
Thank you, Rod. Thank you very much. Let me make sure I can control. Linda, can I control this now? Give me 1 second.
Lucky had given up control.
Oh, so I'm hitting the right key and it's not moving.
Gotcha. Yeah. So actually, I'm sharing my screen, Gary. Do you have your PowerPoint? You can share it if you like. You have that capability, or I can just do kind of how I did with Rod, and I'll just you let me know when to forward this live.
Oh, okay. We can do that, I guess. That's fine. So go ahead and let's get my picture off the screen. It's not that important. So you can go one more, and I'll start. Go one more. Sorry. There we go. All right. So for those, thanks for the introduction, Rod. As he said, my name's Gary Franklin. I'm a tax partner at Cohn Resnick. I work out of the Bethesda office. And I have spent the last several months going back to, late March, early April, working with clients, first applying for the PPP loan, then spending the money. And as Rod said, we're now in the forgiveness phase. So now we're starting to talk forgiveness. Keep in mind that things are changing daily on this stuff. I got something, SBA is issuing things all the time, these FAQs, which we'll chat about a little bit in here, which are coming out regularly. You can go to their website and key in FAQs. I think there's about 50 of them that are out there. There's also stuff that for those that want to see a little more technical flair on things, there's these interim financial rules, which more like a tax code. It goes into more depth and gives you examples, but there's, I don't know, probably 15 or 20 of those out there. So there's a ton of information, plus there's stuff written up by our firm and other firms out there. So if you just put it PPP, you could spend the next 6 months reading things. Just be cautious. Look at the dates that the article was written and drafted, because things have changed so much. So you may read something that, oh, this was how it worked then. It may not work this way now. So with that as a introduction, let me see one. I could try to move this off the page. Okay, I'm good. So with that as an introduction, let's go ahead and get into things. This is a webinar that we, Cohn Resnick, did for our clients and others back in June. After the June 5th, everything came out and changed. A lot of things changed then, as Rod alluded to. So we did this webinar. I've updated it for a few things that have changed since, and I'm sure there's something in there that has changed since I did this a week ago. At least I know there is. So at any rate, where I wanted to start is with the changes that took place in the June 5th changes with the covered period. As Rod alluded to, the covered period it was an 8-week period ending June 30th. It moved to a 24-week period ending the end of the year, or 12/31. So that gave people more time to spend their money in the appropriate allocations, now 60/40 versus 75/25. They also added at that time an alternative payroll covered period. And what that was is there was a problem with people, their payroll periods weren't aligning with their covered period. So for example, you were funded on, let's say, May 5th, and you were made a payroll on, say, May 10th, and clearly that included some payroll that you didn't incur in that period, but you paid in that period. And the rules early on were paid and accrued in your covered period. So therefore, you wouldn't be able to include that payroll, and that was a bad thing for you, because you're trying to get full forgiveness, and you're not going to be able to get full forgiveness if you can't include all your payroll. So they put into effect the alternative payroll period, and that allowed you to move things into your covered period. In my example, if you were funded on May 1st, you would use the first payroll inside your covered period, where you started paying people and they earned it, you incurred it, they earned it, and then it was paid in that period. And then on the back end, you would get that payroll that in the old rules, post June 30, if you made that final payroll, say July 10th, that included some of that stuff you incurred prior to the end of your covered period, you would get that. So the way you looked at it just shifted, and you did get the benefit at that time of 8 weeks of payroll. Now that would be 24 weeks. The next slide, please. As Rod mentioned, also at this time frame in June, they came out with the loan forgiveness applications. With clients were saying, well, how is this all going to work? A lot of people were in the dark, so they came out with the form. The form's been updated a little bit since. The standard form, the 3508 is the standard form. They also came out with an easy form for those folks that didn't necessarily have the complexities that others may have. And in simple terms, the easy form is for those folks that are self-employed, independent contractors, or sole proprietors that had no employees when they filed for application. So it's pretty much a slam dunk. It's pretty easy. And you would fill out the short form, and more than likely, let's assume you get all your loan forgiven. For those that are not in that simplistic arrangement or scenario, they could file the easy form if they meet certain parameters. And at a high level, basically it says, which we'll get into later with safe harbors and all that, is folks that did not reduce their payroll more than 25%, and they didn't reduce their FTEs, their full-time equivalents, then compared to certain periods, then they could file the easy form. Or once again, folks that didn't reduce payroll more than 25%, or met this situation where they had to maybe shutter their businesses, and you had a situation where they can prove through documentation, financial statements, etc., that the period March 1st, 20 through the end of the year, that their business is down relative to the period prior to 2/15. So basically it's kind of a this year versus last year look. And if your business is down and it's all done in good faith and you can support it, then that would give you an out and allow you to use the EZ form. Next slide, please. In addition, we've already mentioned about the 60/40. Prior to June 5th, it was 75/25, 75 payroll, 25 for the other costs, which we call non-payroll costs, which would be in business interests that relate to mortgages and personal property if you had something secured. It would obviously be, it would also include rent, and also it would include utilities. I saw that was one of the questions, what expenses are included. So we'll get into more details later, but that's at a high level what's included. So they went to a 60/40 split versus 75/25. And if you think about that, helps people a lot because they have to spend less on payroll. Because if you were, say, a restaurant and you laid a bunch of people off, you're not going to hire those people back if you've been shuttered, or now you're a carry-out only, or you're down to 10 people in the restaurant at a time. So all these things were happening in real life, and SBA was catching up and putting out further guidance. So that's why this thing has been a changing or evolving every day. The good thing is they're listening and they're redirecting the ship, if you will, and making things really easier so that people can conform. And the goal, as Rod said, is to keep the people employed. That's the whole premise behind this PPP loan, is to really keep the people employed so they're not on unemployment. So they're giving that to the businesses to basically employ these folks. So a 60/40 split. When you get into the payroll costs, many of you probably already know that it's limited to $100,000 of annualized payroll. You can't go above that. So on a 24-week, if you do elect, let me back up real quickly. On the 8 versus 24 weeks, loans prior to 6, 5, or 8 weeks, post is 24. But if you are in that 8-week window, you can elect and use the 24. So you can move if it serves your purpose. Some people burned through the money. They kept everybody in place. It didn't matter. But those folks that didn't, this is a way to give them a little more flexibility. Getting back to this, so on a 24-week covered period, you would be maxed out at $46,154. 8-week, it would be $15,385. In addition to that, it's also capped at 100 grand. You would not be able to include some of these other costs and the payroll costs, which we'll get into later, which also include health, retirement, state taxes, etc. Again, they further tighten things up with owners. So if you're an owner, they have further limited your ability to take your payroll, if you will, and that would be $20,833 on a 24-week period, and $15,385 for those folks still in an 8-week covered period. This talks a little bit about more. Folks can read the slides in more detail later, but as corporations, you can include health insurance, assuming you fit the agreements and or fit the parameters. And those folks that are self-employed or general partners can include health and retirement. Next slide, please. Thank you. Yeah, that's it. Yep. So then you get into this. This here is coming from the perspective of these are things that won't impact your forgiveness. Everybody starts out with the opportunity to get 100% forgiven. It all depends on the math and how you spent the money, and if you spent it right and follow the rules. And if you did, then you're probably fine and you will get 100% forgiveness. But the devil's in the detail, and you may not get that. And when you get into some of these rules here, these are, for example, this FTE reduction, this exception that they have. And basically that says there were situations where people were let go, and the employer then several months down the road or weeks down the road would try to rehire them or someone else to fill that slot, and were not able to. They put out an offer, they got a rejection letter. People didn't want to come back for all kinds of reasons, more so the health reasons. They didn't want to be around people and contract the virus. So that created a problem. So if that was your situation, you wouldn't be dinged on the FTE calculation that we'll talk about later. You would stay at, I could still get 100% if I fell into that situation. Also in the FTE, there's some safe harbors. And this one here talks about, as I spoke a minute ago, if you have a situation where you can prove that your business is down in the period March through the end of the year relative to prior to 2/15, then you could, we would also put you in a safe harbor situation. It would not cause a reduction in your loan forgiveness. Next slide, please.
Hey, Gary,
Um,
sorry to interrupt you, man. Just
yeah.
wanted to let you know, you can actually control it now if you like.
Oh, can I?
Yeah.
How?
Just click on there and you can put left or right.
Oh, up on the screen or on my keypad?
You keep that. You would click on
I thought.
my screen and then just put left or right.
Put on, oh, my screen. Where's my screen? It's not at the bottom, is it?
It should be on the
Here.
Zoom call. If not, we can just continue.
Yeah,
moving.
go ahead and do it. So I'm on page required. I think it's one more slide. I think we're on the next slide. Yes, thank you. So as far as documentation on these few things that we just spoke about on the good faith, you put out the offers, they didn't come back to your employment. Obviously, build a file on that, keep the offer letters in the file, things of that nature. Same thing on if you're going to prove that your business is down, which in most cases, most businesses are down, especially those folks that fall in the hospitality and food service. Those, businesses were really decimated. Probably the hotels more so than the restaurants, because the restaurants have come back to life a little bit. But point being is you need to provide all that information, have all that stuff on file, how you came up with that, whether they were projections, actual through a point in time. You should be tracking this stuff as to where you were when you started this process, applied to how it's gone since, and based on the rule changes and all that, so that you have proper support. Again, you would need to have that documentation to support when you go later on. The certifications is just, you will see when you go through the forms, there's a page or so of questions, and those are basically the certifications saying that I've done this, I've done that. Again, as Rod said, do the right thing, use the money for what its intended purpose is. Don't play games, because it's a freebie. They're handing you this money to keep your business afloat, to pay your people. And it's silly to, drift off that straight and narrow line. Next slide, please. We talked earlier about the prior to June 5th, there was the end of the covered period was June 30th. So you had 8 weeks from when your loan was funded. I don't know if I mentioned that, but the covered period starts when the loan is funded. So if you applied on April 3rd, which was the first day banks open for business, or at least most of them, and you got your money on May 1st, you had 8 weeks from May 1st to spend the money. And the problem with that is June 30th, that 8-week period roughly, was a very short period of time, considering things got worse. Businesses were closed down longer than expected, maybe even still now closed, et cetera. So you got into a situation where people weren't even going to be able to spend the money because they couldn't hire the people back and meet all the requirements. That's one reason why it moved to year end or 12/31. We also mentioned earlier, Rod had mentioned they closed the window on 8/8 for PPP loans. We're obviously beyond that. We'll see what happens in the next bill if something happens. We also discussed earlier with the maturity of loans, the initial loans that are prior to June 5 were 2-year maturity, 1%. They moved that to 5-year maturity, 1%. Talk to your lender if you are in that first phase, meaning prior to June 5th. Talk to your lender. There's a good chance that they can move that for you and move you to a 5-year if that helps, which I'm sure it will. We can go, I think that will help you there. Extension deferral period was discussed. One thing to note is, in addition to what Rod said, is that you have 10 months from the end of the earlier of your end of your covered period or 12/31, you have 10 months to apply for forgiveness. Deferred taxes, that's another thing, we could skip that. Next slide, please. Keep going, please. And we could skip this. This is just a little more detail, which you all can look at on your own as to what I was talking about with the covered periods, the 8 and the 24, the payroll. So we could skip that slide. For forgivable costs, same thing on the payroll costs, what's included. I went over that. This is a little more detail. You can look at that later on. Next slide. All right, so this is the other expenses, or what we call the non-payroll costs. And those are basically in 3 buckets or categories. It's interest, business interest, rent, and utility. And basically it would be, if you have a mortgage, obviously the interest on that would apply. And if you had interest on a business loan that was secured by personal property, that would also qualify. For example, if you had an auto loan, a car loan, so that interest would apply or be included. As far as rent, obviously your lease would be included, or any leases on personal property, equipment. I hate to say copiers. I don't know how many people have, I guess most businesses have copiers. You may have a copier lease, things like that, that would be included. Utilities, that was an area that wasn't really defined in too much detail. It obviously includes the basic stuff that we all know about, gas, electric, water, all that stuff. But then there was this thing thrown in there for transportation. Well, what does that mean? And there's been some more information out on that. I put the stuff that's changed, I put in italic. And they came out on August 4th with another FAQ that gets more into the distribution fees and charges that are included. So when you get into the utilities, if that impacts you, I would do a little more detail, talk to your CPA on that, do a little bit of research. But as you see on the bottom in the bold, this is one thing to keep in mind. Most people, I believe, is what's going to happen since we went from 8 to 24 weeks, so you have more time to spend the money. Okay, because the number hasn't changed. If I got 100 grand to spend, I just have more time to spend it. So what's happened here is most likely, we're seeing a lot of people are burning through the money on payroll alone. So you don't have to get into these other costs. And, maybe you do, maybe you don't. But if you don't get into them, the only benefit of that is you don't have to give them all the backup. You don't have to do all the legwork and all that. On that, we've had a lot of clients that when they got their money from the bank, they set up another account at the bank and segregated that money. So that 100 grand they put in PPP loan funds, let's say, and they drew or paid things out of that account. So they paid utilities, they paid mortgage interest, they paid rent, they transferred money to payroll because that's typically going a different way and you got to fund the payroll account. So that's what a lot of people did just to be, nice, neat and tidy, so that when they sit down with their lender, or if they were audited, if they, have a $2 million loan or more, they would be ready to go and have all the, facts there. So I don't know if anybody's done that, but that is one thing that is helpful. Next slide, please. The eligible costs, as I mentioned earlier, payroll, the way the law was worded initially, it had to be paid and incurred in the covered period in order to be included or go against loan forgiveness. That has been changed just recently. As I said, things are changing regularly. And that goes to Rod's point. The later you wait to apply for forgiveness, meaning closer to your end at least, probably the better, because other things may come out to make your life easier when you're applying. And then all of a sudden you may not be subject to something, which would really be the best thing. So anyway, they changed that to if it's incurred before the covered period and paid during the covered period, that's now eligible. So in my example, you got funded on May 1st and you paid, payroll, say May 5th. So that included clearly payroll from prior to your covered period. And it may include a day or two inside the period, but probably not. You could now include that. So you could get into a situation, if you do the math, you may end up with an additional payroll, which would be to your benefit. The non-payroll costs have always been an or versus an and. So covered period, inside, the costs have to be paid or incurred in the covered period. So an example for a utility bill, obviously you're always paying utilities in arrears. So if you got funded again on May 1st, you paid the bill on 5/15. Clearly, that probably includes time that you incurred, or utilities you incurred prior to your funding May 1st. You can include that, okay, since it's an or versus an and. And then on the back end, you would prorate, so you don't double up, okay? So you get it on the front end, you prorate on the back end. Next slide, please. FTEs. The way, as I said before, everybody starts out with 100% eligibility. And then it depends on what's going on in your world at your business as to whether you have adjustments to that number. And, it's based on these FTEs and the payroll costs. And FTEs, we were waiting for a while how are they going to find that? Because a lot of times if you go through payroll, the Department of Labor stuff, they look at full-time as like 32 hours. or something less than 40, and we didn't know where that was going to end up. It ended up at 40 hours. So as far as going through all the FTE calculations, is each person 40 hours or more is given a 1 weighting or quotient. And if you were below 40, let's say I worked 30 hours, obviously 75%, that would round up to 0.8. So it rounds up to the nearest 10. Okay. You can select the simplified method. Again, it's up to the borrower, whichever works in your favor. They give you a lot of opportunities in the law. So in that situation, again, 1 for a 40-hour person, 0.5 for everybody else. So you'd have to just work the math, but if you have a lot of people that are below 0.5 when you do the math and the round up to the 1/10, it'd probably be to your benefit to use the simplified method because you come out ahead with more FTEs, less limitation. So again, it's a matter, all this is math equations is what you'll find. On the cash comp, what's included in that, because there was a lot of unknown early on in the rules, as time has gone on and the FAQs have come out, they have given much more direction or provided much more direction. Includes obviously gross salary, wages, tips, commissions, paid leave, all that stuff, as you could see on the slide. Next slide, please. Again, for those folks under 100,000, the payroll also includes what I'd call these non-cash compensation items. The employer paid, okay, not the employee paid, but the employer paid benefits for health, group health, retirement benefits, state and local taxes, like unemployment. So again, it's not what the employees been, if there's some type of pre-tax item that they're paying, that's not included. It's only the employer's side. Next slide, please. This is just more on the rules. Again, the split is 60-40 on that. Now you can, as I said earlier, one of the questions talked about, or was, what time period was covered? And they only had 25% for mortgage interest. That was the only thing they had. You can, as long as you can meet on the 60% as far as the payroll, you can spend it all on payroll. You just need to spend at least 60% on the payroll and 40 on the other. But you could spend 100% on your payroll and be done with this, like I said earlier, make life easier and not deal with anything. The EIDL, that would go to reduce your forgiveness if you had that. Folks over 2 million, and that's not just the loan of 2 million, that would be 2 million if you have an affiliated ownership or entity situation. When you all applied for your loans, there was a question at the top of the form that asked, were you an affiliate? And there's some rather complex rules on that. And we've suggested that borrowers, contact your attorneys early on that. But when you get into affiliate rules, it depends on ownership and all the entities and how they're owned. Because as you know, you applied for loans by EIN. And in some cases you would have, I've been in situations where somebody has, say, 10 restaurants and they all operate separately. They all have EINs. They all applied for a loan. So when you aggregate or look at all those as affiliates, because the ownership was the same, so that threw them into the affiliate bucket. Then you had a situation where all of a sudden their loans of, say they had 10, I guess, of $250 each, put them at $2.5 million. All of a sudden they're over $2 million, and they're going to be subject to some different rules, meaning they're going to be audited. Next slide, please. This was discussed earlier too. Once again, 100% forgiveness is the assumption. There are safe harbors to get you out of that. Those safe harbors are with the payroll costs. If you have less than a 25% reduction in your payroll costs, when you look at them in your covered period, whichever you pick, 8 or 24, or the alternate, however you do it, looking at the payroll costs in that period versus the first quarter of 20. Okay, so if you had less than a 25% deduction or reduction, when you do that math, you're good, you fall in the safe harbor, you get a free ticket. Okay, if you're north of 25%, so let's say you're 30%, you do the math and you find out, wow, my payroll went down 30%. You don't get a 30% reduction in your forgiveness, you get the difference between 30 and 25. So you only get a 5% deduction because of the safe harbor. Okay, so it's not they don't wind that back down to 0 just because you did that. On the FTEs, again, there's that exception which I talked about if you tried to rehire and you couldn't rehire. and that was all legit. That's an exception, which doesn't hurt your forgiveness. The other safe harbors in the FTE world have to do with you, just like the payroll, how you look back to one of these periods. In the FTEs, what you do is you look at the FTEs during, again, your covered period, and you compare them to these reference periods. And there's 3 of those reference periods. And it's whichever one works the best for you. So it would be the period 2/15/19 through 6/30/19. So it's kind of a last year look, if you will. And then, or you could look at it January to February of this year. That's kind of before everything started. It was really March where, everything was changing. So you could look at that period and match. And then there's, for those folks with seasonal help, maybe at the beach or something like that, there's some other rules for them where you do a look back. So you would look at those. And again, if you're able to satisfy those, where your costs and FTEs in the covered period are equal or greater than what they were in these reference periods, I'll call them, then you're good. Okay, next slide, please. This has to do with the FTE exception. We've already talked about this. This is, again, the good faith written offer and all that. We can move on to the next slide, please. These are the safe harbors. I kind of talked about all this just a moment ago. So that slide really talked about it from the opposite perspective. I talked about it from the safe harbor perspective, so we could skip that. Documentation, it's like anything that's tax related. Not that this is necessarily taxes, it's more of a lending situation. But you provided a lot of information to your lenders to get the loan at the front end for the application. It's really going to be no different on the back end. You're now going to show them what you spent. So you're going to have to provide bank statements, third-party payroll, reports, payroll filing 941s, things like that. So you'll have to provide all that support, your FTE calculations. What I found is most clients, through working with their payroll provider, ADP and some of the other ones that are out there, have already changed their systems, and they can kick you out these FTE reports. So if you haven't already got them, talk to your payroll people if you're on a system, and they can kick that out. If you have a few employees, you can probably do it by hand and get there just as quick. But perhaps if you have a lot of employees, I would clearly reach out to them. They have all the data. They have the hours. It is a simple calculation. On the non-payroll costs, as I said earlier, if you go all payroll, you wouldn't have to provide all this. So it's just more to do. Your business interest, amortization schedules, copies of lease agreements, all this stuff is going to be needed by the bank in support of your, I'll call them deductions, okay, against the loan. So again, work with your bankers. We're finding things differ between banks. They all came out at different, not all, but things came out at different times. Some were ready to go on April 3rd. Some didn't start for the next week. I know Cap 1 didn't start for, I think, a month. So there were a lot of differences, at the beginning, and a lot of, confusion. And that wasn't anybody's fault. It was just a brand new program thrust upon many people out in the business world, banks, accountants, lawyers, and SBA was trying to control this. The banks were trying to figure out what they were supposed to do. So it's been a lot of work for a lot of people over the last 3-4 months. Next slide, please. This is just more, documentation, what you should maintain. 6 years is what you need to maintain the records. Put this in a file, put it in a safe place. I would put your application in there. Put all the stuff you did at the front end, put all the stuff you did during the period that you spent it, put all the stuff together that you did to go through these calculations we just spoke about. Keep everything together, keep it in a safe place. It may be called upon at a later date, for some questions. Next slide, please. This is just more documentation. Again, submitted with your loan, hold on to all that stuff like I just said, and 6 years is mentioned down there in the second paragraph. We can go to the next slide. When you get to the actual form, You know, as I said, I think there's a whole page which are basically checking the box that you've done this or whatnot. You know, again, as Rod said, I can't stress it enough. Spend the money based on the intended purpose. Follow the rules, and it will be a very simple situation for you. Hopefully, you'll get all your money forgiven, your loan forgiven. If not, hopefully it's a small amount, and you have, you know, perhaps 5 years to pay that at 1%. That's a very small cost to the business. And I understand the businesses are different financial situations, but it is a very small cost. So, you know, when you get into the some of these check the boxes, you know, it's basically going to ask you, did you spend the money on the payroll costs? Did you limit the owners? Did you spend it 60-40 if you go that route? You know, if you're using 8 weeks versus 12 and you have people over 100,000, that you use the caps. That's what all these questions, or I call certifications, will be when you get to that phase or stage. And that's what this is going through. Next slide, please. And this is just more of a continuation. And again, I keep referring to Rod, but what he said on, you know, if you don't follow the rules, if you look at the third bullet, you know, there it's pretty drastic. You will be prosecuted. There are fines, and you could go to jail. So again, do the right thing, use the money for its intended purpose, keep your business afloat, keep your customers, and keep your people happy. So that is all I have. And I know it was quick. I hope, you know, people will have the slides, they can go through and look at things. So with that, I will introduce our next panelist. And she's in the banking side, as it sounds like many people know Sandra. Sandra Sanders Wells is the Senior Vice President and Interim Chief Lending Officer for Citibank and trusted advisor to numerous business and not-for-profit clients. Sandra has been instrumental in the successful growing and expanding the bank's loan, deposit, and cash management portfolio for the past 5 years. She has been providing businesses with targeted financial recommendations, resources regarding lending, deposits, and treasury management investment strategies for over 21 years in the DMV. Sandra, provides clients with the necessary tools to strategically grow their balance sheet and increase their cash flow and banking efficiency. She has over 30 years of experience in commercial lending and financial consulting. Sandra currently manages a client portfolio of 50 million and a bank portfolio of 190 million. City First Bank has been serving its community for over 25 years and is a nationally chartered CDFI and certified B corporation doing business in the DMV, Delaware, Pennsylvania, and specialized in affordable housing. Sounds like a good person to know. Nonprofits, chartered schools, community facilities, and small business lending and financial services. Prior to joining City First, Sandra was a vice president and senior relationship manager at M&T and business banker for First Union Bank, also known as Wells Fargo, who has accumulated a lot of banks. Welcome.
Thank you. Hello, everyone. Well, our process is, you know, this conversation is going to be very, very simple, and we can move to the next slide. Hopefully, the person can hear me. Great, thank you. City First Bank, we are a community development financial institution. We do commercial banking and lending. We really service economic equity in low and moderate income communities. That is really our huge focus. We do affordable housing development, commercial real estate acquisition, nonprofit service providers, and small minority business lending and community facilities. That's really the focus, the key focus of the bank. And as Gary said, we've been doing this for 25 years. So we take a lot of pride in what we do. We are a certified B Corp. And so we are committed not only to our community, but to our employees. So that being said, we can go to the next slide. I'll talk a little bit about the PPP statistics. We served over 135 clients during PPP. We deployed over $33 million in loans. The average loan amount was about $248,000. The largest loan was $10 million. and their smallest loan was $3,722. And one of the things that I do want to point out is that I know there's been a lot of communication and comments about the fact that there was not a lot of loans that made their way to the underserved and Black and Brown communities. And I would like to say that 40% of the capital that we deployed did go to African American businesses and brown communities. So that is something that we're really proud of. That's kind of who we are and what we do. So I just really wanted to point that out. We can go to the next slide. So our process is really, really simple, and everybody has really emphasized all of the documentation and everything that's needed. And the first thing to do is really in this forgiveness process is to contact your lender to figure out exactly how they're doing it. So that you don't get, think that one size fits all. Every bank is probably going to have a different process. So I highly recommend that you contact your lender upfront to see exactly how they're processing and when they're processing. And in City First Bank's case, while we did everything by hand and manually on the deployment of the capital, we have opted to utilize an online platform that's going to guide you step by step through the process. And everyone, there may be a lot of that's going on, and there may be others that are really where it's going to be very manual, and you'll have to physically and manually fill out the paperwork. So you'll have to determine that. But gather your payroll and your occupancy documentation for the covered period, which was somewhere between that 8 to 24 weeks. And as Gary pointed out, the same information that you needed to get the loan is the same information that you're going to need to get your forgiveness. So you definitely want to make sure that you take the time and pull together your paperwork, all of your documentation, what you spent the money on before you even begin the process. You want to submit your forgiveness application to your lender. Once the application is received, your lender will confirm that they have received your certifications and receipt of all of the documentation that you've provided. The forgiveness calculations will be reviewed and confirmed, and the lender has 60 days to do that. After that's been confirmed, reviewed, and that information is correct, the documentation is going to be submitted to the SBA on your behalf. The SBA then has 90 days to decision the package. So don't think that this is going to happen, as quickly as you were able to get the loan. It's not going to be quite that fast. And once we have been notified of the SBA's decision, then we will let you know what the decision is and if and what amount has been forgiven. Somewhere in that process, keep in mind that you could also get requests for additional documentation from your lender. I don't think that once it goes to SBA, I'm not sure, and Rod can, maybe speak to that, is if there was additional documentation that's needed after the lender submits to them, if they could come back with additional questions, but that piece is not clear yet. And again, the most important thing is just as it is that you have all your documentation, it's really important that you retain that documentation for a minimum of 6 years. Do not toss it. You don't know. It's just like with, when you're submitting your business tax returns or your personal tax returns, you hold on to your financial documentation in the event that there is a question or an audit somewhere in the future. And that's really the extent of my presentation. It's succinct, it's quick, but it definitely will take some time to manage through the process. And I think everyone, there's a point that everyone made is don't be so quick to submit for the forgiveness. Everybody wants to hurry up and rush and get it done. But every day, just like during the deployment period, with this forgiveness, every day there's different rules and regulations that are coming out. So don't be in such a hurry. I would at least wait until the end of the calendar year or close to it when things have slowed down in terms of the various changes to the rules and regulations. To Gary's point earlier, there might be some additional regulations that come out that are to your benefit. And if you submit early, then you may not benefit from that. Very similar to at the beginning where it was 8 weeks that you had to utilize the funds, and then it later changed to 24 weeks. Earlier on, it was that you had only a certain percentage of your occupancy costs could be utilized. That then switched to 40%. So the longer you wait, there's definitely benefits. It started at 24, 2 years that the loan would be in the event that everything wasn't forgiven, and it moved to 5 years. So I think there's definitely benefit to waiting and making sure that you understand the entire process and let everybody work through it. There's some folks that are going to be early guinea pigs. Let those folks go forth and pave the way for you later on, and it might be simpler. So that concludes my presentation.
All right. Thank you all. That was powerful and a lot of great information. So now we'll just go into our Q&A session, and we'll try to get through this quickly. I'm just going to go through some of the questions that were presented in the chat, and I guess whoever can answer the questions, if it wasn't directed to a certain person. Alice Walker wants to know, what are operating expenses? Can someone address that? If Gary,
Yeah, I think I mentioned that. Yeah, I mentioned that in the call because I saw that pop
Okay.
up. When, I think it was when Rod blanked out, with his voice or audio. But it is, just assuming you didn't hear, it's all in the slides, and it sounds like they'll be available tomorrow, so you can go back through. But it's interest as it relates to mortgage or personal property loans, business loans, the rent, and utilities. So in a broad sense, that's what it includes.
Okay. Another question comes in. What percentage of variance in staff levels allows full forgiveness? Does 5% variance decrease in staffing while spending more than 60% on payroll still allow for full forgiveness?
Well, this is where the devil's in the details when you're working through the math of the payroll and the FTEs, because that's really a question that involves two different tests. What I'm finding is on the FTEs is what they came out in, I think it was in the June 5th stuff, is where if you can show that your business was, remember, materially impacted from pre-215 to March to year end. So for example, if your business is down 40%, it's basically a get out of jail free card as it relates to the FTE, okay? So you're that's off the table. Then it's just a matter of the payroll costs, and the fact that they moved it from 8 to 24 weeks, I would hope that most businesses could meet it with 3 times the length. And that was the purpose of that. So hopefully that answers the question. So it's someone, and you still have to go through the math for the lender and for the form, but you probably will fall into that situation, especially if you were in a business that was materially affected by this, meaning you were shuttered for time.
Okay, wonderful. Okay, another question, and this might be for Rod, I'm not sure. If I get an EIDL, is it going to be deducted from my PPP forgiveness?
Yes, it will be deducted. Yes, the short answer is yes.
Okay. Let's see. Another one, Richard K has an example. I kept my $20 times H as before. I kept the same number of employees, but there was less business, meaning less hours. Can I check the second box? I'm not sure who's answered that. It is. Can you hear me? Anyway, let's see.
I can hear you. I don't know, have the form in front of me, but
Yeah, I was going to say it's hard.
It sounds like it's a yes.
Okay.
I'd have to look at the form.
Okay.
Yeah.
I could look at the chat and shoot an email afterwards, or you could send me that as an email. That'd be great.
Sure. Okay. Here's another one. When I applied for a PPP loan, I had 6 employees. After I got the loan, I was down 5 employees. We decided to let 1 employee go because of their work ethic. Can I still get the full forgiveness, or should I bring another employee on board before 12/31 to get the full forgiveness?
Well, there is a, go ahead.
Go ahead. Well, if it were me, I'd go ahead and bring on another employee and just keep it simple. But Gary, you can obviously add on to that.
Yeah, I mean, that's, the situation sounds like they would want to try to rehire that person and fill the space so that they can keep all the math working in their favor.
Yep.
Let's see. Okay, here's the question. This is for you, Gary. If we are an existing ConResnick client, should we talk to our regular ConResnick people about PPP forgiveness?
That's who they are. No, I'm just joking. Joking aside, I would start with them because we formed as a company or a firm, we formed a SBA task force, which involves, I don't know, 25 partners throughout the firm. That person, whoever that partner is that works on that person's account, may be on the committee. I don't know. And start there. But what happens is internally, start with the partner, it will get circulated. They may reach out to me, they may reach out to somebody else on the team, and we'll get the answers or whatever is needed. So.
Okay. And I guess anyone can answer this. Do you know if there's going to be a second PPP this year? PPP.
Well, as we know, as Rod said, there's money on the table, and what are they going to do with it? And as everybody's been reading and watching everything on TV, that everything's hung up in Congress as far as where are we going with I'll call it third phase and what's going to happen. But Rod, you probably have more, government knowledge than I do on that.
Yeah, we're still sitting and waiting to find out what Congress is going to do. Again, Nancy Pelosi is saying 2 to 3 trillion. Donald Trump is saying 1.3 trillion. We don't know if more PPP money is going to be allocated under that between 1.3 and 3 trillion, because again, most of the conversation has been on shoring up the unemployment insurance and getting money to the states and the hospitals and everybody else. And there really hasn't been much discussion about EIDL or PPP, so we just don't know yet.
Okay. All right, we just take a couple more questions. Like, is there guidance for government contractors to exclude from PPP loan forgiveness calculation payroll expenses for employees billed on contracts?
The easiest answer to that, and Gary, you can chime in,
Breaking up, Rod.
is as the government contractor, you cannot
Rod, you're really breaking up.
billing the government. Can you hear me now?
No, I don't know. Maybe Gary, you can answer that. Rod, you're kind of fading out a little bit there.
Say the question again. I got government contractors and all that.
Okay, it says, is there guidance for government contractors to exclude from the PPP loan forgiveness calculation the payroll expense for employees billed on contracts?
Well, that gets into when you get into like nonprofits as well, where they had grants and it's to cover payroll. And, I'm not as familiar with that, but if these are contract employees that are still being paid, it's a government contract and they're still getting paid, then really you don't qualify for a PPP loan because that's already covered. So you may have some, I don't know all the facts or the details, but there may be some issue with the PPP loan on the front end that they asked for, a fund based on employees that are really paid by somebody else. There is a lot of discussion in the rules with management companies when you get into real estate and you have a management company that's paying, and then you're reimbursing management company, or like hotel management. A lot of times you have a company that's managing all the hotels, and there was some guidance that was put out. I don't recall all the details, but on that early on, because those folks felt that they were kind of left out and weren't able to apply since they didn't have the payroll on their books under their EIN. So I know that strays from the question, but I would probably, maybe Rod can speak more to that if he can hear us now.
Rod, are you back on? Okay, let me move on. I've got 2 more questions and we can wrap up because we're getting past time. What would you emphasize as the best points to keep in mind for a self-employed owner of an LLC who was disrupted from part-time teaching employment and consulting and education with respect to the kind of record keeping and considerations to keep in mind?
Well, it's basically they're a sole proprietor there, and the way their loan was sized, I guess is the word, was based on their Schedule C, because they probably didn't file an LLC since it sounds like it's a single member. So basically, they would look to their Schedule C, and for simplicity purposes, let's assume they had $100,000 of income. They would go to Sonja and fill out the form, and she would go and do the math, 2.5 times, I'm using 100 because it's simple, it's the highest or the max, and they would have gotten a loan for $20,833 or whatever it is, which is 2.5 times the 100,000 on a monthly average. And they would have to spend that accordingly. Now, it's so then when they get to the forgiveness phase, what's going to happen is they would take that same cost over 8 or 24 weeks, however the math works out. And when we were back in the 8-week period, 8 weeks didn't give you the same result, so you were short. Maybe it was, I think it was 15 or 16 grand versus the 20 that you got from the bank. So you had a shortfall, so you had to use the other, and it was almost a 75-25 split magically. So therefore, you had a situation where you had 25% that you had to spend on other things. And they were the same things as we're talking about here, interest and all that. If you're working out of the home, it's going to, you'd look back to your return if you were taking a portion of your mortgage interest, your utilities and things like that, you would capture those. So it gets a little more complicated, but it also sounds like that person could use the easy form and just work through that and drop on the expenses. And I would hopefully they come out to the point where they spent more than they received, and it's all forgiven.
Right. Well, wonderful. This has been great. Well, Rod, Gary, Sonja, thank you so much. I just want to say that thank you all. And that the links and recording will be available, and they should be available as early as tomorrow, and we'll be sending a link for the recording and the slides. And again, I want to thank everyone for joining us today and for your continued support of the DC Chamber. We hope to see you at other DC Chamber events, and if you are not yet a member, we encourage you to join. It is our mission to be a valuable resource and learning advocate for employers throughout the district. Through our programs, we keep our members informed, educated, and connected with each other through B2B and connected with key decision makers. We have, on September 9th, we'll have our Small Business Awards and Economic Development Summit with our virtual workshops and exhibitors in partnership with DSLBD and the Bank of America. And on September 21st, we'll have our 2020 Health Policy Forum on lessons learned from Wave 1 and preparing for Wave 2 of COVID-19 virtual events. We hope to see you again soon. Any questions you have, please feel free to contact the DC Chamber directly at info@dcchamber.org. Stay safe and well, everybody, and thank you again for joining us.
Thank you.